Hello, and welcome to Chapter 10 in Accounting 205. This chapter we are going to talk about partnerships. Okay, a partnership is an unincorporated business where two or more people come together to form generally a for-profit business. Okay, all right. It will tell you, let's take a look at page 10-2 in your book, okay, and it'll tell you that on there that the co-ownership of property does not necessarily constitute a partnership. So in other words, if two people get together and they say, hey, let's buy a house, let's fix it up and sell it, that doesn't necessarily constitute a partnership, okay? Any other type of business that you would go into, all right, other than buying property and selling it or renting it, all right, would generally constitute a partnership. Okay. The partnerships by default, okay, are legally formed when you have a verbal agreement, all right. However, again, involving real estate, you should have some kind of a written agreement. A lot of times I'll get, a husband and wife that go into real estate together, and they ask me, do I have to file, a partnership return? And I said, no, you do not. Okay, specifically husband and wife, or I guess, spouse and spouse, maybe that would be the better term. You do not have to file a partnership return if that's the only business that the two of you are involved in. If there was any other business, though, okay, you would have to file a partnership return. Okay, what is a partnership? Well, there are two types of partnerships. One, you have a general partnership where all the members are what we call general partners. In other words, they all have a say-so in the running of the business. Okay, and their interest in the partnership generally, okay, is by the amount they contributed, but not necessarily. Okay, that would depend upon the partnership agreement if you have one. Okay, now there is something called the RUPA, which is the Revised Uniform Partnership Act. All right, and I would recommend to you that if you're going to go into partnership with somebody, that you do have a partnership agreement drawn up. Okay, because a partnership can be like a marriage. All right. And a partnership agreement a lot of times is like a prenup, okay? And it can settle a lot of things down the road, especially if one of the partners decides to leave, all right? And because if one of the partners decides to leave and they own more than 50% of the business, the partnership is immediately dissolved, all right? And you would have to develop a new partnership agreement with whoever the new partner is going to be, if anybody. Okay, so that you have general partnerships where all the partners actively are involved in the running of the business, and then you have limited partnerships. Basically, a limited partner is like a bank. Okay, they invest in the partnership, they can share in the profits and the losses, but they do not have a say-so in the running of the business. Okay, limited partners have limited liability, meaning that if the partnership gets sued, the worst that the partner can lose is his or her basis in the partnership. Okay, they can't be sued for their personal assets. Unlike a general partner, which can be sued for not only their general or for their business interests, but also can be sued for their personal interests. Okay, so that in a nutshell is a partnership, all right, that you see on page 10-2. Okay, so how do we form a partnership? Well, generally, the people in the partnership come together and decide what they're going to invest in the partnership. That could be cash, that could be fixed assets, or it could be services. Okay, now you might want to pay attention to page 10-3 because this is where it gets a little bit interesting. Okay, what your basis in the partnership is will depend upon what you contribute to the partnership. So if you contribute $50,000 worth of cash to the partnership, okay, then you have a basis in the partnership of $50,000. Okay, your percentage in the partnership will depend upon the partnership agreement, or just simple math. If you put in $50,000 worth of assets and somebody else puts in $50,000 worth of assets, obviously you both have a 50% stake in the partnership. Okay, so when you invest cash in the business, all right, your basis is increased by the amount of cash that you contribute to the partnership. Okay, now one thing also to keep in mind, and I tell my clients this all the time, that when you invest in a company, like a partnership or a corporation, those assets cease to be yours. Okay, all right, those assets now belong to the partnership. All right, so if you put $50,000 worth of cash in a partnership checking account, that money belongs to the partnership. Okay, all right. If you want to get your money back, okay, you have to get a distribution, and we'll talk about that in another video. Okay. Okay. So a partner can contribute cash, property, plant, or equipment, and or services. All right. If they contribute property, plant, or equipment, generally their basis in the partnership is increased by the adjusted basis of the property. It's very important. The adjusted basis of the property. Okay. All right. Now, what does that mean? Okay. Let's say you have a building that you paid $80,000 for. Okay. The fair market value of that building right now is $150,000. Okay. When you bring that building into the business, you bring it in at $80,000. All right. If that building has a mortgage on it, okay, then you would take the adjusted basis of the property, all right, usually again what you paid for it plus any improvements, okay, and minus any depreciation, of course, if you had previously depreciated the property, okay, and then from there you would subtract your share of the liabilities, if any. Okay, all right. So let's take a look at the two examples at the bottom of page 10.3, because this also involves whether or not you are investing, and the only thing you're investing in is your services. For example, two people come together and they have no idea how to put together a partnership agreement, so they hire an attorney. And the attorney says, okay, in lieu of you paying me, all right, I'll just donate my services. Okay, well, of course, the attorney expects to be paid for that, and the attorney would be paid in the form of a partnership interest, and the only thing the attorney is putting into the partnership is his or her services. So let's take a look at the two examples on page 10.3. Okay, first of all, you have Dunn & Church form a Dunn & Church partnership. Dunn contributes a building with a fair market value of $90 and adjusted basis of $55,000. Okay, well, you can forget the $90,000. The fair market value means nothing when you are starting up a partnership. Okay, so Dunn has an adjusted basis of $55,000 for a 50% interest. Okay, Dunn does not recognize a gain on the transfer of the building to the partnership. Okay, all right, that wouldn't be really fair, because Dunn has a built-in gain of $35,000, which is 90 minus 55. But it wouldn't be fair to tax Dunn on the transfer of the assets to the partnership, because Dunn doesn't technically have the money to pay the gain on the $35,000 difference between the 90 and the 55. Okay, so there is no gain on the transfer of property that has a fair market value higher than the adjusted basis. Okay, Church, on the other hand, performs services, okay, which is worth $90,000. Church has to report $90,000 in ordinary income, okay, in exchange for the services provided to the partnership. Okay, all right. Since church cannot be an employee of the partnership, church would report $90,000 of ordinary income on line 21 of Form 1040. And then to make sure that church doesn't pay taxes on this twice, church's interest in the partnership is immediately increased by $90,000. So if and when church decides to leave the partnership, the first $90,000 will not be taxed. Okay, but it has to be reported. Services are reported immediately on that year's tax return. So if Dun & Church formed a partnership, okay, in 2017, then church would report $90,000 of ordinary income on their 2017 1040. Okay, then take a look at Ann and Keith. Okay, Ann and Keith formed the A&K partnership. All right, Ann contributes a building with a fair market value of $200,000 and an adjusted basis of $45,000. Okay, the building is subject to a liability, okay, all right, of $130,000. Okay, all right, this is a 50-50 partnership. So Ann is contributing a building with an adjusted basis of $45,000, okay, and she is also transferring $65,000 of liability over to Keith, all right, which is 1/2 of the 130. So, you know, it's always a case of what did I get and what did I give up. Ann gave up a building, okay, with an adjusted basis of $45,000. All right, but what did she get? Well, she's off the hook for $65,000 of liability, which is 1/2 of the $130,000 mortgage. Okay, so Ann is actually profiting by this. She gets $65,000, she's giving up $45,000, so Ann has a recognized gain of $20,000, okay, on her tax return for that year. Okay, and she would probably report that under other gains and losses on Form 4797. Okay, okay. Keith, he contributes cash to the partnership, so Keith would not report any gain at all. All right, you only need to report gain if what you get is worth more than what you are getting or giving up. Okay, I'll say that again. You only have to report a gain if what you are getting is worth more than what you are giving up. Okay, in the next video, we're going to discuss page 10.4 in its entirety.